Hello and welcome to the first of our RiskMinds Digital Week webinars. I'm Ed Stapley, Editor-in-Chief of RiskMinds, and over the course of this week we will be discussing a range of regulations impacting risk management today. We'll also be live tweeting this webinar, so you can join in the conversation using the hashtag RiskMindsLive. So today we welcome Riccardo Rebonato, Professor of Finance from the EDHEC. Riccardo will be discussing how to make stress testing work in practice, and is also going to be speaking at the RiskMinds International event in Amsterdam later this year. If you have any questions during the presentation, you can send them to us using the green Ask a Question on the left of your screen. So if any questions come to mind, do pop those on, and I will be asking Riccardo those questions as we get to the end of the talk. So from here on in, it's over to Riccardo, and thanks very much.
Thank you very much, Ed, and welcome to everybody. Good morning or good afternoon, depending on where you're dialing in from. As Ed kindly said, currently I am Professor of Finance at EDHEC. Just to give some background, until recently I was in the financial industry on the sell side before and on the buy side at PIMCO until a year ago. And I have used the techniques I'm going to talk to you today in practice. So it is not just a theoretical, it is not a theoretical presentation. I really want to address what I perceive to be the practical difficulties that most of the times stand in the way of implementing stress testing. Since you are on this webinar, I assume that all of you are bought into the idea that doing stress testing is useful and is important. Therefore, I will go at a very brisk pace on this part, and I will focus on the practical aspects in the second part of the talk. Again, before beginning, I just wanted to let you know, and this is not a plug because everything is absolutely free, at EDHEC we will soon be launching a stress testing tool which will be available to everybody, and in the first instance there will be a number of scenarios constructed according to the methodology I'll be talking about today, and we hope in the near future to make this interactive, so for people to be able to modify scenarios, give input, etc., etc. Finally, and a bit unusually perhaps, my talk begins with a number of references there, which is simply to show that what I'm talking about, there is a lot of detail behind what I'm going to talk about in this half hour, and these are some of the publications that have come out on the topic. And in addition, I have given RiskMind a paper, a details paper that shows the gory details of the calculations I will be talking about today. I have made a choice to keep formulae and derivations to a bare minimum, virtually nothing. I think Stephen Hawking said that every formula cuts in half the readership of a book. I think that every formula also cuts in half the people listening to a webinar, and therefore I have tried to stay at 30,000 feet. Having said that, all the details are there in the paper that you will be able to get from RiskMinds at the end of the webinar. So, problems at hand, as I said, I'll go pretty quickly here. Scenario analysis and stress testing. Scenario analysis, stress testing have always been considered in a way the poor relations in the with respect to quantitative techniques such as VAR, expected shortfall, etc., etc. And the reason is that it is easy to come up with pretty scary numbers, but it is quite difficult to associate a probability to these events. And missing these probabilities, it is very difficult to decide whether it is the case, it is important to take action or not. In the top of the slide, that is one French gare, I think it was La Gare du Nord in Paris, and someone decided that it was not worthwhile worrying about that particular event, and that is what happened. Apart from stress testing, looking at the impact of scenarios, and unfortunately stressful scenarios are always with us these days, is very important also for asset allocation. Stress testing, risk management, asset allocation are linked by the fact that ultimately they all depend on ascertaining what happens given a certain scenario-aware distribution. Very often people think, well, with scenario, you should be thinking the unthinkable. Well, it is very easy to say thinking the unthinkable, and however, from the point of view of acting and of doing something in practice, when you're talking to decision makers, talking to a board of directors, it is very difficult to convince anybody to do anything by saying, well, I've been thinking the unthinkable. If senior management is to act on the results of stress testing, it must be intuitively and it must be cognitively resonant. It must make sense, no black boxes. First of all, they must be dynamic and responsive, which means that as situation changes, the outcome of a stress test must change pretty quickly. The IMF in the 2008-2009 crisis said, hey guys, you banks, you were telling me you were doing stress testing all the time. When I asked you to run a few stress tests, it took you weeks to come back to me. If even the most obvious stress tests took many weeks to prepare and assess, how could this test meaningfully be used to manage risk? So we need something that is quick and responsive. Again, very briefly, approaches to stress testing. One is, looking further out in the tail. You have a loss distribution and you use techniques such as extreme value theory. This is all well and good. However, it has very little what I call cognitive resonance. You don't convince a senior decision maker by saying, look, my fancy model, my EVT model assigns this probability of a huge loss. I am not able to tell you what combination of events will give rise to this loss. Bank of England recommends vulnerability-driven stress testing. So you look at your portfolio and you say, well, I have a big concentration here. Let's stress this concentration. Could be in mortgages, could be in commercial real estate, could be in equities, whatever it is. The problem is that when you move this risk factor associated with that asset class by itself, you have no idea why this is happening, and therefore you have no idea how other parts of your portfolio are moving at the same time. Therefore, what I find much more appealing is the idea of a coherent causal scenarios. There is a scenario in which the attempt is made to link all the main risk factors of a portfolio in a coherent narrative. In this way, offsets and feedbacks can be taken into account. It must be logically coherent, but intuitionally appealing. Well, I've been working with Bayesian nets for a long time, and I think that Bayesian nets are a technology that serves the purposes of stress testing very, very well. What are they? I'm giving a baby example here, going again very, very quickly. I want to ascertain the probability of John, which is in the green box at the bottom, will slip while walking on the pavement. Now, the probability of John slipping is a function of whether the pavement is wet or dry. John is error-prone, so sometimes he slips even if the pavement is dry, but the likelihood of John slipping is much greater if the pavement is wet. Now, why can the pavement be wet? Well, there are mainly two reasons. One is because it has rained, or the other one is because the sprinkler was on. The interesting thing in constructing this Bayesian net is that in theory I have three variables, rain, sprinkler, and state of the pavement, that affect the probability of John slipping. However, once I know whether the pavement is wet or dry, it no longer matters if it is wet because of a sprinkler or it is wet because of the rain. The state of the pavement screens the variables rain and sprinkler. This is the intuition behind the huge computational and cognitive saving that Bayesian nets offer. So Bayesian nets lend themselves to an intuitively but logically coherent description of a complex scenario. They ensure consistency amongst its variables. They produce the consequences of a scenario assumption in a transparent and understandable manner. A senior decision maker can say, sorry, I don't like this net. I will show you an example of a net very shortly. What happens? What if we do this instead of this? and it is possible to change the assumption and see immediately what results and what happens. Ultimately, Bayesian nets can be thought of as a tool to obtain the joint distribution of returns of a multitude of assets. And this joint distribution is of essential importance whether we do risk management, whether we do asset allocation, excuse me, whether we do portfolio analysis. Bayesian net, the technology, is agnostic about the optimization route or about the risk management technique that we use. It just provides a coherent, intuitively understandable, and easily updatable joint distribution. Again, I will go quickly here. And how do I obtain the Bayesian net part of the distribution? There are a number of variables. Each variable is represented by a node. A number of states for each variable, good state, bad state of the world. A conditional probability table that tells me the probability of a child node given the parent's nodes only. A child node would be the pavement and the parents are rain and sprinkler. And then a causal link among the variables encoded in the directed arrows. The variables in a Bayesian net are the roots, which are the prime causes of a scenario. For instance, Italy undergoes a disorderly default, North Korea, you name it. Intermediate nodes, which are the transmission channels, for instance, the failure of a bank, the intervention of the ECB, etc., etc. And finally, leaves, which are the ultimate effects, the change in the market risk factors, for instance, changes in treasury yields, corporate spread, US dollar, etc., etc. So the name of the game is to propagate in a logically consistent manner the effect of the roots via the transmission channels down to the leaves. Here I have a simple UK-centric example. I have a case of a sovereign crisis. It could be Italy, it could be Greece, it could be a number of other peripheral countries, not a number, hopefully. Ultimately, at the bottom, I have three asset classes. I have UK corporate credit spreads, UK equity prices, and gilt prices. And in the middle, I have a number of transmission channels. So depending, since I have a UK-centric portfolio, I distinguish between the status of UK banks and European banks. And then I have QE for UK, readjustment of risk premium for UK, government rescue of bank, etc., etc. And without going into the details, you see how there is a narrative here with which, again, a senior decision maker or a head of trading or a senior trader can engage, connecting the sovereign crisis down with my risk factors. The computational and conceptual saving with Bayesian nets, excuse me, comes from the conditional independence. Again, I'll go back here to the previous slide. Conditional independence means, let's take UK corporate spreads. UK corporate spreads is assumed to depend only on the readjustment of the risk premium. Gilt prices are assumed to depend on occurrence of QE and whether the UK government rescue UK banks. Once I know these states of the world, I don't need to know anything above. I don't need to know the state of sovereign crisis, distress European banks, distress UK banks, etc., etc. Where do the conditional probabilities come from? The conditional and marginal probabilities come from a combination of implied market quantities, for instance, CDS spreads, subjective inputs, our understanding of what causes what, and statistically determined quantities. The subjective component is crucial, but is unavoidable when analyzing a scenario. If we had a lot more time, I could make a case here that even supposedly objective risk management techniques such as VAR and conditional expected shortfall, etc., are much more subjective than one would like to think. However, life is short, time is limited, and therefore I will briskly continue here. Given subjective inputs, clearly we want to make sure that our results are not terribly dependent on small changes in our subjective inputs. And it is one of the nice features of Bayesian nets. It is very, very easy to carry out sensitivity analysis. Here I have how much the joint probability, which is the ultimate result, changes, excuse me again, for a change in my input probability. And also in this case here, I have changes in subjective input probabilities, and these error bars give me the confidence level for the perturbed joint probability table. The big probability here, at the one at the very far left, is the probability of nothing happens. Remember, we are dealing with rare events, and these are the other joint probabilities here, and you see the uncertainty is very acceptable given the requirements of stress testing. Again, to give a flavor, I have another example here that connects the possibility of Greece exiting the EU via defaults of Greek banks, peripheral governments, recession in the euro area, risk on or risk off, recession in the UK, and now in green down here, I have three asset classes, 10-year bonds, or rather three assets, 10-year bonds, FTSE 200, 250, and 10-year gilts, and in orange at the bottom, there is my portfolio. This is all very neat and stylized, but the heart of the matter is to go from this very appealing but very stylized construction to something practical. Here we are at the heart of the discussion. These are my outstanding technological problem. For portfolio applications, there is one important hurdle. They must be vaulted over in all stress testing applications. There is nothing special with Bayesian net. If you are wedded to some other way of obtaining stress analysis, I am sure you're encountering the same problem. A typical scenario establishes links between and assigns value to a handful of major risk factors. These are the leaves of a Bayesian net, which are a small number of risk drivers. Unfortunately, the value of a realistic portfolio depends on the realization under the condition of stress of hundreds of risk factors. One of the big technological problems is the following. How do we assign the changes in the hundreds of risk factors once we assigned in each scenario a configuration for the handful of hand-stressed variables? So, I have put down three technological problems here. This is the dimensionality problem, which I just mentioned. Because of their subjective components, stress tests refer to a small number of risk factors. Realistic portfolios, however, are affected by hundreds of risk factors. How can one propagate a stress configuration from the small to the large domain? The second one is a consistency problem. Every scenario stress test implies a correlation matrix among the risk factors. This correlation matrix can be radically different from the unconditional correlation matrix. However, it must converge to the unconditional correlation matrix when the probability of a stress event goes to zero. How can I achieve the consistency of a scenario-aware and the scenario-naive correlation matrices? And finally, and this is very important, and I know that there are some providers, software providers, big companies, who say, don't worry, I'm going to solve the dimensionality problems with a gazillion of regressions. However, all these regressions are run using data that pertains to normal market conditions. But this relationship, this regularity, these regressions do not apply when the stress has occurred. So that methodology is fundamentally flawed. And this is what I'm trying to explain how to improve on and overcome. To find a solution to the dimensionality problem is more digression. Recently, with my ex-colleague Ivan Soroka, I have published a paper in Journal of Fixed Income, which is called How to Deform a Yield Curve. In that case, the idea that we have, the problem that was a practical problem, is we have a trader who has views on the 5-year and the 10-year and says, I think they will move by this amount. What does that imply about the movement of the yield curve as a whole? So we have solved this problem in a very, if I may say so myself, elegant way. This paper ended up being the 3rd most read paper in Journal of Fixed Income in the year in which it was published. And the method starts from a number of subjective views on a number of yields and finds, using principal component analysis, the most likely deformation of the yield curve. But it has given me an idea. One can do an obvious extension. It doesn't have to be a yield curve. I just need a correlation, covariance matrix and principal components amongst a number of assets. In scenario analysis, the terminal values of the leaves can be thought of as the views. Remember, let's go back for a second. Let's go back so we are totally clear on this. Let's go back to this picture here. In this case, the 10-year Bund, the FTSE 250 and the 10-year gilt, in each one is 3 states, so each configuration of this is a view. And what I have to do is, what is the most likely configuration of all my assets, given that the 10-year Bund is in these states, the FTSE 200 is in these states, and the 10-year gilt is in these states. The states of these 3 green variables correspond to the views, and the configuration of the other variables are the deformation of the yield curve. So let's keep this in the back of our minds. How to do it, again, I'm not going to explain here. It is very, very simple. It is a linear problem. Let's suppose that we know how to do it. So suppose that we have n leaves, terminal risk factors, as a result of a stress scenario. As we discussed, this number is small. If each leaf has 2 possible states, good and bad, then we have 2 to the n combination that we call configuration. If you have used a technology such as Bayesian nets, we can associate a joint probability to each configuration. This is useful, but I would like to get the joint distribution for the large portfolio in correspondence of each configuration of a small set of shock variables. So, as a first step, I'm going to assume that there is a deterministic mapping between the values of risk factor in the small set and the risk factors in the large set. So this is the same assumption which is made by the big software providers. The difference is they enforce this deterministic link using a regression based on normal times. I'm going to do something different. So if you're happy with the deterministic mapping assumption, it is very tempting to use the how to deform a yield curve approach described above, where now each configuration in the small set is a view and the yield curve is the large set of risk factors. However, the conditioning problem still stands in the way. To do the how to deform a yield curve trick, I need principal components, which need a covariance matrix, which need a stress scenario-aware covariance matrix. What we need is a way to transform the event correlation among the small set variables into the correlation matrix among the large set variables. The small set variables were the 3, the 10-year Bund, the 10-year gilt, and the FTSE 250. I can get an event correlation very easily using Bayesian nets, but I would like the correlation amongst the many, many, many assets that I have in my portfolio. So this is how to do it. We assume that we have an event correlation matrix. This is a correlation matrix between the leaves in our portfolio. This is a small correlation matrix. I have 3 in the stylized example. In practice, I might have order 10 leaves at the bottom of my scenario. Okay, let me go more quickly here. Now, first, this is the crucial bit. This is the trick. I'm going to assume, again, that the mapping from each of the scenario configurations for the leaves to the values of the variables in the asset variables is deterministic. Second, this is the heart of the matter. We assume that different asset classes might display different correlation during a stress event than in normal times. However, within that asset class, I assume that the members of the same asset class retain the same correlation with members of the same asset class. Let me explain what this means. In normal times, I observe a certain correlation between, say, equities and fixed income, between the S&P 500 and the 10-year Treasury. Now, suppose that the asset class is developed equity market. So I have FTSE, S&P 500, DAX, etc., and then I have another asset class which is developed market interest rates, 10-year Bund, 10-year Gilt, etc., etc. So I am saying that the correlation between the asset classes might change. However, the correlations between the FTSE and the S&P 500 remain the same, even if the correlation between equities as an asset class and interest rates as an asset class might be different during a stress scenario. So, for instance, during a crisis, the correlation between developed market equities and US Treasuries may change. However, we assume that, say, the FTSE and the S&P will retain the same degree of high correlation during the crisis. So, let's skip again. Now, let Ni be the number of members of the ith class. Suppose the first class is developed equity markets. I have 6 entries in there, FTSE, S&P 500, CAC, DAX, etc. So I have N1 is equal to 6. And let Ni be the number of the members of the class directly shocked by the scenario. In my scenario, remember, there was a FTSE 250. So in that case, there was only one element that I have shocked. In this case, I suppose that I'm shocking 2. Typically, it will be one element per class. Remember, in that picture there, we had the FTSE. Construct the event correlation matrix amongst the shocked members of each class. So I have shocked the FTSE 250, I have shocked the 10-year Bund, I have shocked the 10-year Gilt. Construct this event correlation. Separately, calculate the correlation matrices amongst the members of each class using the normal times correlation matrix. Why the normal times? Because I'm saying that the correlation amongst the elements of that asset class doesn't change. There is a caveat here that I will skip in order to keep the discussion clean. Given the orthogonalization of the event correlation matrix, now we simulate, when I have principal components, I can simulate many realizations of the directly shocked asset class members. Remember, those were the 10-year Bunds, the 10-year Gilt, and the FTSE 250. So this means simulating, in this simple example, 3 variables. For each realization of these 3 directly shocked risk factors, I can determine the most likely deformation of all the members of that asset class using the principal components for the covariance between the elements of each asset class. This has been obtained using normal times covariance matrix because we are saying that within each asset class, the correlation doesn't change. So to be clear, given a simulated realization of, say, the FTSE 100 and the S&P 500, we determine the associated realizations of the other members of the first asset class, developed market equities, taking the simulated realization of FTSE 100 and S&P 500 as views. Remember the view technique, propagating this deformation to the other developed market indices. I build, just a second, I've been a tiny bit too quick there. Let me go back to the last. This means for each realization of a simulation, we can determine a vector made up of number of assets elements. Number of assets is the large number of assets in my portfolio. we build many such vectors, each of dimension number of assets. From these simulated vectors, we can construct these vectors know about the stress. So from these simulated vectors, I can construct a correlation matrix which is scenario aware among the n asset elements that constitute the whole investment portfolio. Once we have a stress correlation matrix, we can build the conditional covariance matrix necessary to create the scenario aware normalized principal components. With this, we can finally apply the views-based approach described above. Now, this is actually very simple, may not be completely clear just by looking at a number of slides moving in front of your eyes during a webinar, and that is why I put all the details in the paper that you will be able to access from RiskMinds. But again, the procedure is actually very simple, and the fundamental assumptions here are the following. Each asset class moves in the way that the scenario prescribes, perhaps generating a covariance, a correlation very different from the normal one. However, within each asset class, S&P, FTSE, etc., retain the same correlation structure as in normal times. If you think that, say, the FTSE will behave differently because of Brexit, for instance, then you have to take the FTSE out and make it a member of a class of its own. So, in half an hour, I can only hope to have given you a flavor for the techniques that can be employed to make stress testing a practical and useful tool. As I said, there are many, many details in the references I've given you, and I would very much like to hear your comments, to hear your questions, and perhaps to engage in further discussion down the line. Thank you very much. Thank you for your attention.
Thanks a lot for that, Riccardo. Fantastic stuff. And as you said, we'll now take some questions from the audience. So any questions at all, do just submit those via the green Ask a Question box on the left-hand side of your screen. But to kick things off, Riccardo, I've got a question here. You mentioned the need to make the scenario probabilities consistent. What does this mean, and how is this achieved?
Right, yes. Consistent, I touched that very briefly, but it's very, very important. What it means, again, is that suppose I want to do portfolio allocation, and let's forget about stress for a moment. Portfolio allocation is based on information from the covariance matrix. You might not be totally wedded to a CAPM view of the world, in which everything comes down to the beta, which is a covariance. You might have a more complex model, but at the end of the day, it is this code diversification is based on correlation between different assets. Now, when I assign conditional probabilities and links and arrows, etc., I implicitly create not only a diversification, a correlation between assets during the stress, but also a correlation amongst assets in normal times. It is essential that when the probability of the exceptional event goes to zero, I should recover the correlation that goes into my CAPM or whatever. It is more important for portfolio allocation than for stress testing, but for portfolio allocation is absolutely fundamental. Now, how do you do this? You simply do this by setting to zero your probability, or to a tiny number, your probability of the stress event occurring, of Italy defaulting or whatever it is, and by making sure that the event correlation you obtain at the bottom is consistent with the normal times one. If it is not, you tweak in a systematic manner your conditional probabilities until this is achieved. That is particularly important if you're doing portfolio management, investment allocation.
Good stuff. Thank you, Riccardo. I've got another question here. It says that isn't the simulation using the normal times correlations just the same regression that you were mentioning that the vendors were using?
Yes, but careful, because I am using it only within the asset. So you have to ask yourself, is the assumption that I am making reasonable or not? What is the assumption? The assumption is, given my scenarios, equities, developed equities, might do very badly or might do very well. And these might be very different, and they might behave very differently from what treasuries do in normal times. However, once I accept that developed equities do very well, then I expect that the FTSE will do well, and the S&P 500 will do well, and the DAX will do well, unless I have country-specific concerns. In which case, the normal time correlation used only within the asset class is perfectly fine to use. Remember that the representative elements, the FTSE 250, the 10-year Bund, and the 10-year Gilt, can have a correlation completely different from the normal one, but each one of these three guys drag along all the other members of its own class in the possibly very different correlation, event correlation. So it is not the same at all as what the vendors offer.
Thanks very much for that, Riccardo. We do still have time for more questions, so do keep those coming in. Another question here is, wanted to ask whether the specific technique is applicable to stress testing of loan portfolios, and if yes,
definitely,
which are expecting to be the leads?
Definitely. Again, if you have a loan portfolio, I don't know how complex, if it is super concentrated, if you have loan portfolio which has a diversity of types of loans. If you had only UK residential, US residential, for instance, that's at this point the problem is somewhat simpler, and it is closer to what are the application of these techniques to a transaction. The difference between portfolio transaction is that in the case of a transaction, you have very, very few and perhaps a single risk factor, in which case everything is much, much simpler. In every case, you have an event at the root, transmission channels, and in the case of a loan portfolio, if a loan portfolio is concentrated, it becomes like a rugby ball, because you have a construction that ends up all converging into this relatively very small number of risk factors. So there is a continuum, if you want, from a complex portfolio. I know a bank which statistically is a bit ridiculous, 250,000 risk factors. I won't go into that, but that is a statistical sin. And I have seen applications, and I've been engaged in applications with a buy-side asset manager, in which we were analyzing specific transactions. It was 2012. It was the time of the possibility of a euro breakup, and we were looking at the euro implied volatility surface using this technique, and that obviously everything had to converge there in what does the euro do with respect to dollar. So definitely the technique is applicable to extremely diversified or extremely concentrated portfolios, with anything in between.
Okay, thank you, Riccardo. And we've got a few more minutes. I've got another question here, which goes into some of the parts of your talk. How do you apply your method to a specific transaction rather than a complex portfolio?
Excellent, excellent. That goes exactly to what I was saying. In the case of transaction, many of the problems I have addressed in here don't even arise, because you simply have to focus on the transaction of interest. Another case that we looked with the buy-side asset manager was the 2-year Brazilian note, and it was Petrobras, and there was impeachment, and there was all these things going on. And in that case, all your transmission channels converge down onto your 2-year Brazilian note. So in a way, it is much simpler. But the reason why I brought this up, I have I have dealt with these problems today is that transaction applications are of great interest to hedge funds, to asset managers, to traders who engage in specific strategies, but that technology doesn't really apply to either a buy-side or a sell-side institution who has to say, I have to apply the stress testing to a complex portfolio. That is what has, in my opinion, stood in the way of using these type of techniques widely when you have complex portfolios. And what I'm trying to offer here is a way of dealing with a tough problem.
Okay, thanks a lot, Riccardo. I think that's all we do have time for, unfortunately. There are some comments here that we will pass to you, and you'll have some time to answer. And for those of you who are interested in delving further, Riccardo's webinar, his webinar will be actually available or as an article, and it'll be on our RiskMinds blog this afternoon. So do contact us for that, and we'll get that across to people. So thanks, Riccardo, again for joining us.
Thank you to everybody. It's been a real pleasure.
And we look forward to seeing you at RiskMinds International in December and hearing more about those.
I am looking forward myself, and thank you for telling me he's no longer in Geneva and is in Amsterdam. Otherwise, I would have shown up at the wrong airport.
Not ideal, but no, we look forward to seeing you there. Thanks everyone to coming along, and make sure you keep an eye on your email inbox for our monthly newsletter, which will bring you insights and discussions on a year-round basis. So if you've got any feedback to those who've listened today, or any recommendations for future webinars, please do complete our short survey at the end of this webinar, which will flash up on your screen shortly. So thanks again, Riccardo, and hope to see you all soon. Cheers. Bye-bye.
Brilliant. Thank you very much. Bye.